How's it going?
Welcome, welcome.
So, Liam.
What's up, Bobby? Yeah, I got held up the past two meetups, so.
All right. So before we formally introduce Yonah, this is the fun time, the snapshot time. All right. So let's give me the best smile of yours and whoever that's behind the screen. Give me your smile, guys. Give me your smile. I'm gonna count 5. Okay. 5, 4, 3, 2, 1. There you go. All right. Nico, who are we having today?
We got our man, Yonah Weiss. So Yonah Weiss is also known as the Cost Segregation King. He's a master communicator, networker. He's an educator and a LinkedIn master. He has helped hundreds of real estate investors in saving tens of millions of dollars in income tax through cost segregation with Madison Specs, and has been a guest on over 90 of the top real estate podcasts on the subject. His abilities to attract business by adding value for his clients and clients to be are self-evident by his activity feed, recommendations, and endorsements. Needless to say, if you need a cost segregation study, you would be wise to seek out my man, the hashtag Cost Seg King, Yonah Weiss.
All right.
What an introduction.
Welcome, man. Thanks for coming.
Got a lot to live up to with that one, but very good. Yeah, it's great to be here. I really appreciate it. I know we had been trying to get this plan for quite a while. We have a conflicting thing because I also have a meetup every Wednesday night, which is usually the time you guys do it. So I'm very grateful to you guys that you've been gracious enough to move this. And so I apologize to everyone else who had to inconvenience to change this up tonight, but I really do appreciate it. And I guess we'll just jump right into it because our time, I want to make sure we have enough time. I do unfortunately have a hard stop tonight at 8 o'clock to be giving another webinar for another group. So let's just do this. Anything I should know before we start, Joseph, Nico?
You could just start sharing and roll the dice.
Roll the dice. All right, let's do it. Where's the share button? There we go. Okay, let's do this. Let's just start from the beginning over here. Okay, here we go. The magical world of cost segregation. A little bit about you introduced me. I don't need to do any introduction. I work for the largest national company, Madison Specs. It's an acronym, Specialized Property Engineering Cost Segregation. We're not an accounting firm. We're specialized just doing this service, so it's pretty cool. Let's just get right into it. Please do ask questions. Stop me if something is not clear. I try to be as clear as possible, but I tend to talk a little bit fast. So if something's not clear, put it in the chat box, right? Joseph and Nico will be monitoring that, and feel free to jump in if you feel it's appropriate to stop at the time. If not, we'll get them all at the end. Put in as many questions as you can, and let's just get right into it. We'll go into cost segregation. We'll talk about depreciation in general because it's a pretty important topic to understand and to not be confused by the misconceptions of it. And we'll talk about the benefits. We'll talk about bonus depreciation. It's not something different than cost segregation. It's something just on top of it. And we'll get into, when should we be doing it? Who's the right person? When's the best time? And most importantly, probably the most important topic of this conversation is what is a real estate professional? It's a very heavy topic. Something that's discussed a lot. Something that's confusing to a lot of people. We're going to try to clear it up as much as possible and then get into a actual case study, which we'll talk about throughout, but I think the case study itself at the end, make sure to stick around so that you can get that going. So I just slide through 5 slides there. So what is depreciation? Okay. We're good. Depreciation.
We're good.
Or depreciation is it's a misconception because when we talk about tax, it's really just a borrowed term. And I want to explain what I mean. Depreciation, the definition means something's going down in value, okay, as time goes on. And we understand that, right? When you drive a car off the lot, you know that it goes down in value, right? As soon as you cross the lot, even though intrinsically it hasn't gone down in value. So too with real estate. Now, real estate happens to be usually appreciating. I mean, it's going up in value as time going on. So we have to understand why this is, why the IRS gave this tax incentive, but more importantly, how we as real estate investors can take advantage of this apply it and use the tax strategy of cost segregation to maximize it. So generally speaking, when you buy a commercial property, now it can be any property, even if it's a business property, investment property, it doesn't matter as long as it's not your personal residence. And we'll get into maybe, you know, if you live in a duplex and you're house hacking, maybe you live in one unit, renting out the second, you can do it as well, proportionally to how much is an investment property. But regardless, when you buy that property, you're allowed to take what's called a depreciation deduction, which means you can now write off as an income tax write-off, income tax deduction, the entire value of that purchase. Okay, that's called depreciation. However, it has to be done over a long period of time. Okay, so arbitrarily, the IRS gave a 39-year period that schedule starts the day you buy the property. Okay, and or 20, that's for commercial properties. 27.5 is for residential or multifamily properties. Okay, so you take that purchase price, you divide that up by, you subtract a certain amount for land, which does not depreciate, and then you divide it up by 27 or 39. That's how much income tax deduction you'll get. So what does it mean, income tax deduction? You make money, that's your, you know, income from your rental properties. You immediately wipe off the top, you know, a little bit of that deduction, and then you can go forward. However, just a little bit each year, about 2 to 3%, if you make that calculation of your purchase price every single year, is very nice, but it oftentimes doesn't wipe out the entire tax liability. It comes in cost segregation and is a strategy that allows you to actually borrow from your overall deductions over that long span period of time and kind of take that up front and front load a lot of those deductions into earlier years so that you can increase your cash flow, etc. So that's in a nutshell what depreciation is and how cost segregation works. We'll get into the, you know, the nitty-gritty details shortly, but let's just see an overview. What is, let's say you buy a building for $1 million, okay? And I want to illustrate this with $1 million because usually cost segregation is going to be very beneficial at that price point, even less than it can be, but you'll see from the example, it's going to be great. Like I said, you immediately have to subtract from the top 15%, not 15%, land allocation, okay? A national average is 15%. It could be 10, it could be 20, it could be 50 in certain locations, New York City, San Francisco, you know, California, places like that. There's sometimes very high land values. And so your land allocation, whatever that is, whatever is left over, that $850,000 in our example, that's what's called your depreciable basis. That's the amount that you can now take as a tax deduction over that long period of time. So let's say you're going to straight line depreciate this. It means you're going to take the entire amount and just split that over 39 years, over 27.5 years. Your deduction is going to be every year $21,000 if it's commercial building, or $30,999 if it's a residential building per million. Okay, this is pretty simple math according to this, which means if you make your net operating income, your rental property income after all expenses is $50,000, let's say, immediately you wipe off the top 30 and you only have to pay taxes on the remaining $20,000. Okay, that's simply how depreciation works. Now, if you have a $10 million building, you're going to have, you know, maybe five. And again, 50,000 was just an example. You may be making $100,000 from that property. You may have multiple properties that you're making all this money from. Depreciation can be used against all that rental property income. And that's how it works. However, with cost segregation, we're allowed to allocate a certain amount to 5-year property, to things that depreciate faster, and sometimes double, triple, or even quadruple the amount of depreciation taken in the first year, first 5 years, which means you can basically paying little to no income tax, usually during the first 5-year period. That's how it works. And we'll get into the examples shortly. So let's just talk about the fundamentals for a second. Why is this that you haven't heard of this, okay? One reason is because it's an accounting thing, right? It has to do with taxes. We're talking about taxes over here. But it's also an engineering thing, okay? Which means accountants can't do this, right? Accountants can apply the depreciation, but they can't understand, they can't do the actual cost segregation because it involves engineering. What does that mean? You need to have an engineer come to the property to analyze the entire building and, you know, see what all those assets inside of it are, reclassify things to faster depreciation lives, because essentially what the IRS says is like this. Your building, right, loses value as time goes on, okay? But there are certain assets in your building, like personal property, which depreciate on a much faster schedule, meaning they have a much shorter lifespan. Why? Carpeting, for example, you're going to have to replace every 5-10 years. Okay, appliances, you're going to have to replace every 5-10 years, right? Which means they have a shorter lifespan, which means you can now take that tax write-off of that value over a faster period of time. That allocation needs to be done by a trained engineer, and that's what the cost segregation study does, okay? And this is accelerating the depreciation. Again, it's something that is a huge thing to do, but accountants cannot do this on their own unless they're, a very large accounting firm that has engineers in-house, which many of the large accounting firms do. So I alluded to this about a minute ago, but let's just break down how, what this allocation is doing. What are we doing when we're doing a cost segregation study without the weird name, right? We're segregating the cost of the building, meaning we're breaking down the building, the property, into many different components that depreciate at faster rates, meaning you can take those tax write-offs at faster schedules. So there's usually 4 categories. One is land, we talked about. The second is the building. That's the main structure, and that includes stuff like doors, windows, roof, floor, walls, okay? That's the building. That's usually gonna be the the majority of your depreciation is gonna be allocated into that main structure, and that's on a 27 or 39-year schedule. You can't change that. What we can change is we can reallocate stuff to what's called 5-year property, okay? Inside the building, anything that's not structural, even if it's attached, like cabinets, like carpeting, vinyl flooring, but all this stuff like decorative lighting, right? You can see in the category over here on the left side of the screen, equipment, furniture, basically anything that's not structural. All of those things, all of those components, the engineer identifies how much of that is in each building, in each property, et cetera, and then they assign a value to them, make a very complex calculation of how much that is worth and what's the depreciation lifespan, 5 years for all these things, and now we can take that deduction of adding up all that value and take that up front. Okay, that's one category. The second category is 15-year property, which is land improvements, meaning anything that is outside of your property, outside of your building, landscaping, pavement, concrete, okay? You have a parking lot, you have sidewalks, all that stuff has value to it. Identifying that value allows you to take the tax write-off of that value over a 15-year period, okay? And all kinds of other stuff outside the building, right? Signage, retention walls, all that kind of stuff. So now, when we do this, oftentimes, especially with multifamily properties, all this can apply to any type of commercial building. It's usually going to be between 20 and 30%, okay? 20 and 30% of your building value is going to be in these faster depreciation lives, which means you can literally take that at a much faster rate of depreciation, okay? Huge. So think about that for a second. In our example earlier, where you had $30,000 of depreciation in $1 million building, by doing the cost segregation, you're going to be allocating, let's say, $200,000, all right, to the first 5 years, okay, which is huge. And we're going to talk to in a minute about bonus depreciation, which allows you to take that in the first year. So again, this is doubling, tripling your tax deductions in these earlier years, and this is a game changer for a lot of people who want to have a lot of cash flow, want to be able to reinvest, and most importantly, right, not pay taxes when you don't have to. And that's, I think, like the biggest fundamental here. The IRS says you don't actually have to pay taxes here, okay? Here's a way, a legal way for you to take more deductions than you have income. Go ahead and do it. Now, they're not obligating you to do it, but you do have to actually do the study. You have to go through the, jump through the hoops to actually get this done. So let's talk about different types of properties. Okay, there are many different types of properties. I mentioned multifamily, but every type of property has a different amount that can be allocated to faster lives. So like I said, apartments, usually between 25, 30%, sometimes more depending on the type of property, sometimes less. If it's a city property, there's not much land improvements. You just have building, sidewalk, street, right? There's not much there. There's usually not going to be a lot of land improvements in that, okay, which can be significant in garden style apartments. Other types of properties that are very, very good, retail properties, hotels, right? Manufacturing facilities, as you can see, are upwards of 30, 35% of that, again, to faster lives. The second to last one, as you can see over here, MHPs, that's mobile home parks. These are literally off the charts, okay? It's huge. Why? Because when you're buying a mobile home park, usually you're just buying the land and the land improvements. The homes, especially if you don't own the homes, they're owned by the tenants, you essentially just have land and land improvements. That land improvements, remember the concrete under each home, the pavement, the roads, the landscaping, the walls, fencing, et cetera. All that stuff has value to it. And when you're buying that property, essentially that's where your value is. Okay. It's in the land and in that and nothing else. So that's why it's literally off the charts. You can have 50, 60, 70. I've seen upwards of even 80% allocated to these 15 years faster depreciation. So this is huge. Warehouses obviously is going to be very little because there's not much in there besides for walls, maybe some shelving, if there's an office in there, et cetera. So let's just recap here for a second. Everyone's with me? If you're with me, just, I don't know, you can't talk here. You can't. Maybe so. Nico, we're good?
I'm with you, my man.
Okay, we got a thumbs up. There you go. What do we do in the cost segregation? Let's just recap this. I know some people came in a little bit late. We're reducing our taxable liability. Why? Because we are creating more deductions. We're not creating, I should rephrase, we're not creating new deductions, we're front-loading deductions, which means we're able to capture tax write-offs from our overall period that we can take over 39 years, 27 years. Maybe we're not even going to hold the property for that long. So better to take advantage of it now. That's really where it comes in. We are, again, paying less taxes increases our cash flow, okay? If you made $100,000 and you have to pay, a 30% tax on that, so really only made 70,000, okay? But if you don't have to pay taxes on that, you made $100,000. You keep that, you can reinvest that. Think about the compound interest. And this is really what the real estate game is all about, is about paying very little taxes. And, some people, the media likes to criticize, right? President Trump, right? Jared Kushner, all these things like to criticize people for, gaming the system. No, it's not really gaming the system. The system is there. You just have to be smart enough to actually take advantage of it. And I'll quote, or I'll paraphrase rather, Tom Wheelwright, very famous author, Rich Dad Advisor, book, Tax-Free Wealth. If you haven't read it, I highly recommend you read that book, Tax-Free Wealth. He says something in that book that is just mind-boggling. He says in the chapter about depreciation, he says, you're not obligated. The IRS does not require you to do cost segregation, okay? So the question is, well, why not? If it's considered the proper way of depreciating your property, you're actually supposed to do it this way. So doing it the straight line, lumping it together, that's actually wrong. You're not supposed to do it like that. You're supposed to break it down and take everything accordingly. So why don't they make you? Why don't they obligate you? So he says something to the effect of, they know that the laziness and the ignorance of the taxpayer and or their accountants is just contributing to the U.S. Treasury. So we have to hear things like that, not be insulted by it, but rather be empowered by that, be inspired by that. How can I be more proactive in my taxes? How can I be more proactive so that I can keep the money that I'm making and not, kind of demonize, people who are taking more deductions when they're actually just smart enough, or their accountants are smart enough to take advantage of those deductions that are available to them. Okay. I think it's a really important topic there. And it's really more about the time value of money than anything else. Okay. And that's the real estate game, is how can you make money and have your money make you more money? Okay. So the more money that you have, and you know how to have your money make money. So the more money you have, the more money you can make. Okay. And again, this is something that just comes back to the fact that, yeah, we're not creating deductions out of thin air, but we're able to take advantage of that, so that, because a dollar today is worth a lot more than it will be 5 years from now. Not just because of inflation, which is 2 to 3% a year, but because what you can do with that money, right? If you know how to use it. And bonus depreciation we'll get to shortly. So who should be doing a cost segregation study? This is, really open for anyone who has a taxable liability, anyone who pays taxes. If you're a nonprofit, you can't do it. If you're a government entity, can't do it. You don't get depreciation. If you're investing from your retirement account, in certain retirement accounts, Roth IRAs, for example, 401ks do not have self-directed 401ks, et cetera, do not have the ability to take advantage of depreciation because they're already sheltered. So you're not touching that money, right? You can't take the depreciation for that. So doing a cost segregation would just be, an exercise in futility. I probably wouldn't recommend doing that. However, if you're a corporation, if you're LLC, it doesn't really matter how it's structured. However much equity you have in that partnership, that's how much depreciation you're going to get, and it's going to be split evenly across those partnerships. Okay, now is the moment we've all been waiting for. We're talking about cost segregation, we're talking about depreciation, but it's not just about how many deductions you can get. It's more about how much of it you can use. Okay, so that's why this slide is the most important, because yes, cost segregation, by doing it, will create these huge, massive deductions, and oftentimes, more often than not, will actually create what's called a passive loss, meaning if you have more deductions than you actually have income, then you have what's called a passive loss. It goes into like some imaginary bank account and just gets carried forward. You can't use it this year, but you can use it next year, and it carries forward to future years. However, if you are a real estate professional, okay, and this is something really, really important, that means that you spend the majority of your time, your business, either you or your spouse, only one of you needs this designation to get this status. You can now use those passive losses, those extra deductions. You don't have a limitation to it. You can actually use it against not only your rental property income, but your active income, any other source whatsoever. So let me just take a step back, redefine this. Rent depreciation is considered a passive deduction. Real estate is considered passive income. So the passive deduction offsets the rental property income. If you make money from real estate, that's rental property income. That is passive income. Your depreciation goes to offset that, and that alone, okay? Unless you are a real estate professional. So if you're a W-2, both you and your spouse, and you're a doctor, lawyer, whatever it is, and you also have rental properties, unfortunately, you cannot use those extra deductions against your ordinary income. It has to be applied only to your rental property income. However, if either one of you are a real estate professional, you can now use those deductions to offset your ordinary income beyond your rental property income. So let's say you made $50,000 from your rental properties and you had $100,000 of tax deductions from depreciation. $50,000 is used against the rental property income, and the other $50,000 can now be used to offset your ordinary income. That's how this real estate professional status works. Again, you have to be working the majority of your time. You can't have another job, W-2 job, and you have to be materially participating. Okay, so it's not just enough to have an investment. You actually have to be involved in the day-to-day. The other qualification is you have to work 750 hours a year, which is not a lot. If you're working full-time in real estate, it's about 15, 16 hours a week. However, you need to actually be able to track these hours. The IRS, and every time that someone's been challenged with this, if they didn't have, in an audit, if they didn't have actually hours tracking what they were doing and they could be supported by those activities, then they lost basically. So it's important to be able to track those hours as well. So what do you need to track? Okay, if you are involved in the real estate property business, developing, redeveloping, constructing, reconstructing, acquiring, okay, if you're involved in acquisitions, converting, you're involved in, dealing with the municipalities and all that stuff, renting it, leasing it, operating it, managing it, brokering it, all of those activities are considered activities that qualify for these hours that allow you to get this status. And again, this is a huge status because again, it's not just about how much deductions you can get. It's about, can you actually use them this year, or are they just passive loss that carry forward? Okay.
Hey, Yonah, can I stop you for a second?
Absolutely.
We had a quick question in regards to the EQRP. Is that in the same boat as the self-directed IRA or the solo 401k as far as tax shelter?
So I can't speak specifically to the EQRP because that is just a trademarked product that someone trademarked. It's not as far as I know, it's not a specific entity. It's a QRP is another name for 401k. So it's a little bit complicated. I would make sure to check with your provider. If it's an EQRP, then I know who your provider is. Make sure that you're getting all the information that you need from them, because oftentimes you may be sold on the bells and whistles and not necessarily given all the information about how is it going to affect you in the long term.
We're having Damien come on the next as our next guest, so he can address it then in 2 weeks from now.
Hopefully, yeah. Okay, great, good question. But as far as I know, it's kind of a glorified 401k.
Agreed.
With fancy trademarks. Okay, if you do not qualify as a real estate professional, and so there's one instance where even if you don't qualify as a real estate professional, you still can use some of those deductions, those passive deductions, and that's if your adjusted gross income does not exceed $150,000 a year. So if it doesn't exceed that, then you can actually use a certain amount, up to $25,000, a certain amount of that to offset your ordinary income as well. If you have extra deductions extra losses. Okay. So let's talk about the Tax Cuts and Jobs Act. This is something probably the biggest change that's been in the tax code for real estate professional, real estate investors over, for the past 50 years. And this is something called bonus depreciation. This was introduced by, President Trump in the Tax Cuts and Jobs Act, a huge tax reform, where essentially what he said, and it's still around, it's still in the books, and it's going to be around through the year 2022. And even if Biden gets elected, this is still in the books, and this is not going to change, even though he claims to be wiping out the Tax Cuts and Jobs Act. You can't do that unless Congress wipes that out. But regardless, they're not going to wipe this out because this is in the books. And but President Trump is actually, I just read today that he's actually said that he plans to make this permanent, not just until 2023, but to make the bonus depreciation permanent. So you can use it 100% forever. So what does this mean? What is bonus depreciation? Once you do a cost segregation study and you identify what the 5-year property is, what the 15-year property is, meaning all that stuff that depreciates at a faster rate, you can now have the option to take all of that, 100% of that in year number 1. Okay, it used to apply just to new construction and was only up to 50%. Now it's 100%. And this has been, like I said, the biggest game changer. So think in our example, we bought $1 million property. Instead of taking $30,000 every single year for depreciation, with cost segregation, the first 5 years, you could maybe get $160,000 to $200,000 depreciation every year. Sorry, not every year, for split over a 5-year period, which is basically going to be doubling your depreciation. Comes bonus depreciation and says, guess what? You can take that entire $200,000 as a tax write-off in the first year. Okay, so this is huge. Again, creating huge losses and can be used by those who can use them. And it's going to start phasing out in 2023. It's going to go down to 80% and then 60% until 2028. It's no longer going to be. You can still do cost segregation, but you won't get that extra bonus that you can take it all up front.
Yonah, can you do bonus depreciation without doing a cost segregation study?
No, because it's essentially, it's just applying the cost segregation in a different calculation. So you need to have the cost segregation study done in order to identify what those assets in the property are that depreciate faster. Once you identify what those things are, then you have the option to either spread them over a faster period, 5-year, 7-year, 15-year, or take it all up front in year number 1. So when we do a cost segregation study, we actually just make both those calculations for you. And allow you to choose, what's going to fit for your investment strategy.
That's awesome. Thank you.
And it does not apply to a 1031 exchange because without getting into the complications of a 1031 exchange, your basis is not a new basis, meaning the amount of depreciation you have in a new property when you buy it through a 1031 exchange is not brand new. It doesn't start over. Like a normal property, when you buy it, your depreciation schedule, your 39 years, your 27 years starts over based on your purchase price. When you do 1031 exchange, your depreciation is actually carried over from your previous property, and it's has already started when you bought that previous property, and the amount that's left over is carried over and can be depreciated further. So bonus depreciation does not apply to a 1031 exchange. This is something really, really important that just came out with the CARES Act a few months back, or a few months now. It's already about like 6-7 months back. The time is flying when we're in a pandemic, right? But they came out with these great incentives, trying to find all kinds of ways people can save money, right? So one of the ways was through taxes, right? Taxes, we know, is the greatest expense that any individual or business owner has. They introduce them or reintroduce something called a net operating loss carry back. Okay. We had mentioned previously that if you have net operating loss, you have a passive loss, you can carry it forward. If you have more deductions than you have income and you're not a real estate professional, and even if you are and you have still more deductions, it carries forward. You don't lose it. You use it next year. This carry back means you can actually go back 5 years. If you paid income tax over the past 5 years, you can now go back and amend your previous year's tax returns and apply the losses from a cost segregation you did this year and apply those backwards to previous years and actually get a refund check from the IRS. That's what a net operating loss carryback is. It's huge. So if you paid taxes in the past 5 years, it's worthwhile to get a cost segregation study done, buy a property this year, do a cost seg, get it done, apply those taxes backwards, get a refund check. So that was one of the ideas that Congress came up with to stimulate the economy. People have money, get a refund check, etc. So that's pretty big as well. Although it does involve amending your tax returns, so not necessarily the easiest thing to do. You have to involve your accountant and file a special form as well. So it comes with that risk, but could be worth it. When should we be doing this? Okay, it can be done at any time, and really this depends a lot on who you are. What's your business plan? Does it make sense? But a lot of people get it done in the first year, not just to take advantage of the bonus depreciation, but in general, to take advantage of the tax incentives, get these passive losses. So people reach out to me all the time, even before they buy the property. You're under contract. We provide a free analysis to anyone just to show you what your potential tax savings would be if you did a cost segregation study. So that's important to do if you're looking at buying a property, if you're under contract, or once you get it done. Once you close on it, that's the best time to get it done. The other time to get it done would be if you did major renovations. As I mentioned at the beginning, when you buy a property, that's when your depreciation is set in stone, okay? Your purchase price, and then you subtract for land, and that's it. It doesn't change. It doesn't matter if you bought a distressed property and it was worth half, 50 cents on a dollar, and you got, 2 years later, you get a refinance and you get a new appraisal and it's worth 10 times as much. It doesn't matter. It does not change your depreciation. Unfortunately, your tax deduction is based solely on the amount of money that was spent on the property. The one time that does change is when you do renovations. You add money into the property. And you don't have to add the money yourself, meaning it can be financed. Also in the acquisition, if you buy a property for $1 million, you're not putting $1 million down, from your pocket. You're usually borrowing money from the bank. Nevertheless, you get the tax deduction as if you paid the whole $1 million. Okay. Same with the renovations. Even if the bank paid $1 million to renovate your property and you didn't pay a dime, you get to take the tax deduction of that $1 million, which is, again, another crazy thing, another huge thing, a benefit, especially when you go and do a refinance, the money you get back is not taxable. So again, someone has to explain that to me how that works, but it's pretty incredible, the tax incentive that comes along with that. So when you're doing a major renovation, you're adding money into the property. Those monies that are spent can be allocated through a cost segregation study into, you're spending money on replacing the appliances. Guess what? Those are 5-year property. You can take that as, bonus depreciation. You're repaving the parking lot, 15-year property. You can get that done. If you're replacing the roof is structural, 27-year property can't help you with the cost seg, but that money is applied to your tax return as, new depreciation over that period of time. The other thing it's really important to note is that you can do this retroactively. Okay, you can do what's called a look-back study and actually catch up depreciation that you could have taken in previous years. Let's say you bought a property, 2 years ago, 3 years ago, 5 years ago, and you were just doing straight line depreciation, and you realize, well, this year I actually have a big tax liability. I need to get some extra tax deductions. What can I do? One great strategy is to get the cost segregation done retroactively. And what this does, without amending your tax returns, actually gets to catch up whatever depreciation you could have taken in the past 5 years and take that this year, which gives you basically a huge lump sum of tax deductions. So that's really huge. And again, this catch-up depreciation does not require you to amend your tax return. You have to file a form 3115. It's a tax form. We actually do it as a service at no extra charge for our clients because it's something that people don't, accountants aren't really familiar with that much. Change of depreciation. So let's jump right in to the case study. Everyone ready? Everyone's still with us. I see we lost a couple people, but that's okay.
Yes, we're ready.
We're good. Okay, the case study is as follows. This is multifamily property, North Carolina, 1.75 million. It was a very nice purchase, 32 units. And with this property, this particular owner, and I always tell the story, it's a great story. He owned a bunch of single family properties and he had sold them and tried to do a 1031 exchange. It failed. He ended up having to deal with a huge capital gains tax bill on the sale of those single families. However, he bought this 32 unit at the same, that same year, later on that year, and was able to do cost segregation study, and we'll see the happy ending shortly. So normally his regular depreciation deduction would have been $54,086 every year. Again, we're taking the purchase price, we're subtracting some for land, we're dividing that by 27.5, and that's your deduction. Now his income on this property, net operating income, was about $120,000, $130,000, which that's great. The 54,000 was offset with that. However, the remaining, $70,000, $80,000 was still there that needed to be, you had to pay tax on that. So what we did was Cost Segregation Study, and this is a pretty conservative, I would say 28% altogether. But what we did was allocate 15% for land. And then the building, remember, that's always going to be the structural stuff. That's going to be the majority. 72% is in that bucket. And that $1 million is going to, we're going to take that and divide that by 27.5. Okay. So you're still going to get from just the building itself, you're still going to get, instead of 30,000, in that example over 54,000, you're still going to get about, $35,000, $40,000 a year just from the structural component of depreciation. That doesn't change, but we can front load a whole bunch more. So the 15-year property, we're front loading that about 122,000, about 8% of the landscaping, the pavement, all that stuff. The 5-year property, that's all of the personal property, the appliances, furniture, fixtures, carpeting, cabinets, countertops, all that stuff that's inside the building. It's not structural. 20% of the tax basis was in that category. So altogether, about $421,000 was the accelerated depreciation. Again, on top of the regular depreciation. So what he did was take this amount, he took bonus depreciation, took the entire amount as deduction. Again, about $120,000 of net operating income, wiped that out. And he had an extra $300,000. What did he do with that? He applied that to the huge capital gains bill that he had. And he was able to knock off his whole capital gains tax that he thought he had to pay from the failed 1031 exchange. So that was just like an icing on the cake that you can use these deductions. It's all about the strategy. It's about how are you going to use it? How can you use it to benefit you? However, there is something I should note over here, which is, before we get into, what should you look for, is what happens when you sell a property. I mentioned capital gains tax, but there's also something called depreciation recapture tax. Okay, which means that you have to pay a tax on the amount of depreciation that you took. So it's great to take these extra deductions. However, you do have to pay tax on it, or you don't necessarily have to pay the tax, but you're going to have a tax bill. Again, when I say you don't have to pay, it doesn't mean, illegally, but it means that if you have strategies like cost segregation, you can actually knock off that tax bill as well later on. But you have to face it, which means you have to plan accordingly. If you're holding a property over a short period of time, maybe a year or 2 years, it may not be worth your while to get the cost segregation study done, because you're going to have to face that bill in a year or two. It just may not be helpful depending on your business plan. I oftentimes say that my rule of thumb is any property purchased for over $500,000, it's worthwhile looking into, getting a cost segregation study done. The bigger the property, the better. Obviously, because it's percentage, we're allocating a certain percentage, but you can see here very clearly from a $1.75 million purchase, there's a huge significant tax benefit over here. Okay, so definitely worthwhile. What goes into a cost segregation study? This is taken directly from the IRS's website, and I'm going to finish out this basically the last slide over here. So we'll take questions in a minute. But you have to have a lot that goes into it. So it's not something you can do on your own. It's not something that you can just kind of pick this number 20% and say, yeah, I'm going to apply that to my taxes, take 20% of depreciation. No, you actually have to have this, this long, study, which is this huge report, 80, 100 pages long, that details everything that's in your building and how it depreciates, et cetera, using methodology, using documentation, nomenclature, numbering system, et cetera. So it's not something you can really do on your own. So looking for engineers, accountants, all together, that's what we do, blah, blah, blah. That's Madison Specs. Any questions?
Awesome job, Yonah. Hey, guys, so you can unmute yourself and ask a question. He's only got a few minutes left, so don't be afraid if you felt overwhelmed by anything that he said. I'm sure somebody else felt the same way, so ask that question that's in your head, because if not, my questions are going to come out.
Yeah, and by the way, if I did not answer any questions, or I don't have the time, or you think of something, a few minutes later after I jump off, please go ahead and connect with me on LinkedIn if you're not already done so, and make sure to hit me up over there.
Awesome. I'm going to do like a little summary as people are thinking or whatever.
I have a question.
Oh, perfect.
Oh, yes. Hey, great info, Mr. Weiss. Thank you. My question is, to qualify as a real estate professional, I don't own any properties, but I'm underwriting. I'm, doing everything leading up to acquiring our first property. Does that qualify in any way as, as time that you can log as a real estate professional?
if you actually end up buying the property during the tax year that you apply for that, or you attempt to qualify for that status, then yes, meaning the amount of time spent during the acquisition process, not for other properties, but for that specific property that you buy, because it's all about spending time in your rental property trade or business. So just in the acquisitions mode itself is not going to help you. If you work for a corporation, right, you work in a REIT and you're on the acquisitions team, that also doesn't help you unless you own a 5% ownership in those properties, which I don't think you do.
I see. Thank you.
Yonah, so my question upon that one is, so let's say I spent hours and hours, like really work hard to underwrite this deal, ended up not getting it, and you can't use that?
I would speak to your accountant about it, but probably not.
Oh.
I know it sucks.
I do have a question. I don't know if you can hear me.
Yeah, Rob, go ahead.
You do, Rob. Yeah.
Hey, what's going on? So good presentation. Real quick, just kind of like situation specific, but I have a duplex that I'm currently getting a cost seg on, and my 5 to 7 year goal is to wreck it and redevelop. How does depreciation factor into the new development?
That's a great question. So if it was in your plan to, is it rented out currently? Just I'll speak on your specific situation.
Yeah, it's currently an investment. I live in one half the duplex and rent out the other. I'm about to move out and rent out the whole thing.
Okay.
But yeah.
So depreciation applies once you, if it's a little bit complicated, if your intention when you bought it was to wreck it and redevelopment and it wasn't a rental property, which is not your case, but I'm just bringing it up, then you can't do depreciation on the acquisition. You just have to wait until you do the redevelopment. Okay. However, in your situation, you can actually double dip, meaning you have the rental property, you're taking depreciation as is, you can get that cost segregation. Once you wreck it, rebuild it, once that property is placed in service, when you finish and you start renting it out, when the new property is finished, then you can do a cost segregation again on the new development, on the cost of construction.
Awesome, man. Awesome information. Thank you.
No problem.
I've got a question.
Yeah,
So
go ahead.
You'd mentioned it being worth looking into a cost segregation study for any property that you're buying for over $500,000. How much does a cost segregation study typically cost, and is it cost prohibitive if you were looking to buy a property for under $500,000?
Excellent question. It typically it depends from property to property, but typically I can just speak to our firm. That's why I say that we charge somewhere between $4,000 to $5,000 for the cost segregation study, which is not cost prohibitive per se. I mean, if you have a $500,000 property and you could potentially be getting $70,000 to $100,000 of extra depreciation from that, paying a few $1,000s is not cost prohibitive. However, it's not like you won the lottery. It's limited and it's percentage based, which is why I don't push it on it. You can definitely get it looked into, get it done on a smaller property. However, I don't recommend it per se, unless your situation would require that.
Okay. Thank you.
My pleasure. Thank you.
Yonah, what about pass through to limited partners on a syndication? How do they benefit?
Pass through, depending on your structure, but usually each investor, depending on their percentage of ownership, they get that percentage of depreciation. So let's say everyone has, invested a certain amount of money in the deal, and with that investment, they get X amount of shares, they get X amount of equity in the property. That percentage is how much of the depreciation they'll get. And it passes through.
All right. Anybody else? Because we can give him a minute of relaxation before his next meeting.
Yeah, if no one, I guess that means, Yonah, you did a great presentation, wiping out all the questions, just like Cost Seg wiping out all the tax liability.
Wipe out all the questions.
Yes, because you actually answered two of my questions, the depreciation recaptures. So
Very cool.
Awesome.
All
All right,
right.
Yosef,
Thank you.
close it out, or?
yeah, I think because Yonah has to get off. So thank you very much, Yonah, for coming. And today was really great presentation. And I'm sure everybody learned a lot about cost seg and tax issues with multifamily. So everyone, thank you very much for coming. Nico and I usually stay a little bit. If you guys want to chat a little bit after this.
And we got to get Yonah's info.
And oh yes, Yonah, how can people get in touch with you?
Definitely find me on LinkedIn. I think there's only one Yonah Weiss. If you're on LinkedIn, you'll definitely be happy that you connected with me there. You go to yonahweiss.com. Also, just check it out there. Get all the information about the Weiss Advice podcast. Make sure to check that out. And that's about it.
That's right, man. Awesome podcast. Also, I'll put all of that with the podcast and all the links in our follow-up email to everybody. So they'll get all those 3 links you just mentioned: LinkedIn, your website, and the podcast.
Cool. Thanks so much. And thanks to everyone for joining. And hopefully I'll see you another time.
All right. Thank you very much, Yonah.
Thanks, Yonah.
Bye.
Thank you.